So we have a situation right now where the stock market is going up. Um, it's kind of rallying today. We have some contrary indicators here. One is um, the Fed is raising rates. Anyway, it's the Jerome Powell spoke today. He said they're going to probably raise. Don't don't count out raising rates in the future. So that usually makes the market go down. I'm not sure why it is making it go up. So we look at our S&P 500 chart. We can see it's a perfect channel, and we're at the top of this channel, and we're levitating basically. This is called climbing a wall of worry. When the stock market is rallying and we're gaining momentum, and this is towards the end of the year, and usually we would check down to like if it was a normal chart, it would go up and down in this saw-like way, but it isn't. So it's actually the end of the year. We have a lot of end of the year. We know that November and December are some of the best months of the year seasonally. And November turned out to be the best month since like 20 years or 10 years. So it went up a lot. And December, it looks like we're off to a pretty good start. But we are overbought. So for short-term buying and selling, it's not a good time to buy or sell. Buy, but it's a time not to buy if you're a long-term holder. So we look at our meeting notes. We're in the first month of December, and we're right here. So we have a Fed meeting in the 13th to look forward to, and we have the year-end Santa rally, and that usually happens the last week and sometimes the week before. We have a lot of fund managers playing catch-up, so meaning if they have to explain to their shareholders what stocks they're holding, and a lot of times they make their window dressing, it's called, towards the end of the quarter. And right now what's happening is these stocks that have done well so far are being bought, and there's some tax loss selling on the ones that did the worst so far. So so that's probably why the good stocks that have gone up so much this year have gone up more, and the ones that have performed poorly are being sold off for tax loss selling. So we see what the Fed is going to have another meeting on the 13th. A lot of times there's some worry about that. So I have the next week of December as cautionary times, and we're also overbought. So I'm thinking we're going to go down, or it's not going to go anywhere for a week until the meeting, and then after that we're going to have like an end of year rally again. But we have a recession probably coming in February or so, and I don't know if it's according to Jeffrey Gundlach. I think that's important to know because a lot of times stock markets go down when there's a contraction in the economy. But there's 70% chance that we're going to have some rate cuts in March, April, or May. So that means that a lot of the tech stocks that have been going down due to interest rates are going to be going up because interest rates are going down. And then you'll have a return for home demand right in time for home selling seasons in the spring. So when interest rates go down, people want to buy houses usually. All right, so let's look at the stochastics for the rest of the indexes we're following. Most every one of them are overbought. You can see they're kind of levitating right now, and we're gaining momentum in the market. So you can see we have this link here in the notes. It's the number of S&P stocks above the 50-day moving average and 200-day moving average, and it's getting better every week. So this is like a sign of momentum. And so we also have market breadth. That means a lot of stocks are participating now, and before it was just the top 10 tech stocks. You can see this week we have the 10-year and the 2-year down, And usually when the treasuries go down, the stock market goes up, and that's been a correlation that's kind of held up for a while. I don't know how long this is going to last, this correlation, but it works basically until it doesn't. Right now, you can see as the treasury went down, the S&P has gone up. So that's good. So far, it's working. Now we're going to have corporate buybacks this month, and we're having inflation that's getting better. We've had better inflation reports. So that's good. So that's all markets, catalyst for markets going up. And let me see. Okay, we're still, the companies doing great in an environment of rising rates are ones that don't need to borrow money. But now that interest rates could be starting to go down, it's time to start thinking about these companies that have been thrown out and with the need to borrow money. All right, so we have, we saw the S&P 5. We're super overbought right now. It's still at 91. And we're kind of levitating in the December timeframe here. So now we have, oil is down to $76 a barrel. That usually is an indication of weakness in the global economy. We had OPEC meeting this week, and it didn't really do anything to the price of oil. But there's probably going to be a global recession. For our long-term investors, that's just a period of time, like maybe 6 months to a year, where the stock market doesn't really do anything, doesn't go up. And so you have to be willing to hold through those time periods. It doesn't worry me much, because a lot of times whenever there's a recession or some kind of contraction in the economy, the Fed will reduce interest rates and it'll be back to normal pretty fast. Okay, one thing that changed from the last week is inflation is going down. So it was 3.7 last week, now it's 3.4. And so that's really good for the stock market. If things start calming down, then the interest rate thing won't be a problem anymore. And the dollar index is up a little bit, just 0.5%. It's not that much. So if you're in greed, we're still greed mode. So we have momentum, we have greed, we have seasonally good time of the year. That's a really good indication that we're going to have a positive December. And this is the first day of the month. So let's see. So this is an example of we don't want to buy when everyone else is buying. We should have bought whenever we were fearful and everyone else is fearful. So okay, U.S. dollar index is continuing to go down. It went up just a fraction this week. But you can see this is good for the U.S. stock market because most stocks sell things overseas, and this helps their earnings. So the other thing is the VIX is down another 1%. So it's at 12. That means that is like as low as it's been since the beginning of the pandemic. So that means there's no fear in the market, and it's a bull market. So let's look at right now our investor sentiment. We're greedy right now. And we have this new AI paradigm where everyone's excited. We haven't been through a capitulation together or a fear situation. Right now, towards the end of the year, most likely we'll be having this greed, and everyone on TV will be positive. And that's but we have to keep in mind all these major issues that could crop up as something that could cause a capitulation. But if it does capitulate, then you can't just sell. You have to make sure you understand the 10-year time horizon that you have if you're investing that far in advance. And we always like to look at this. Right now, the U.S. interest rate's 4%. So then people are willing to pay. You have to say what they're willing to. Right now, the PE ratio for the S&P 500 is 20.37. So it's actually going up because the stock market's going up. And the yields are actually going down. So the yields are now 4.3%. So as yields go down, people are willing to pay more for the S&P. So we'll keep an eye on this right now. But so far, if you take out the top 10 stocks in the S&P 500, the PE ratio is 15, which is the average. So there's still a little bubble with the top tech stocks. They're a little bit overvalued. Here's a little interesting thing I found on Twitter. It's called the best business models. The Morgan Stanley did this survey, and they have a lot of analysts covering stocks, and they figured the best business models. I thought it was interesting that sometimes you have moats, and sometimes you have a good product that's durable and will be around in 20 years. It's I like to look at this because these are examples of stocks with good business models that reinvent themselves over time and have, like for instance, Microsoft. They have the monopoly in desktops for Windows, and right now they're making a cloud offering to those people, and they're also offering AI services for their Office clients, which they have a monopoly in Office too. So that's a good business model, for example. And I think we can go through each one of these. I don't know half of the names, but we can see a lot of the names that we follow are on here. We have Apple, of course. They have 2 billion active users, and they're selling services to them. That's probably the best part of their business, and it's growing. Let me see. We have Eli Lilly in there. We started following them recently, and they have a lot of breakthrough drugs that are coming out now that are in high demand. Possible Alzheimer's drug, and let's see what other ones are here. So for Warren Buffett, he likes to have stocks. He likes to own stocks that have a durable competitive advantage and have good, well-run businesses. And so these stocks are ones that have the best business models, according to Morgan Stanley. So Nike has a business model where they might make shoes really inexpensively and sell them direct to consumer and through third-party places like Foot Locker. So that's an example, and they're moving towards selling directly to the customer. So that's a good business model. Visa, they're a toll collector, so they take very little risk whenever they're allowing transactions to go through. They just take a portion of every transaction, and so that's an example of a good business model. And let me see. Here's one right here, Ferrari. They're an example of a company that you have backlog of people wanting to buy their cars at really high prices, and they make a lot of money per car, and so that is their business model. They don't make many cars, but the ones they sell are selling for a lot. So and it's a niche, and they have a steady demand, and they still have a backlog of customers that they make cars for. So I like to look at this every once in a while just to see if anything we're following is in there also as a good business model. All right. So we're following Ford, and we've been seeing Ford as like a problem child in our portfolio of stocks we're following. It's every day there's a new story that comes out that there's more problems for this company. Recently they had a UAW labor deal that they struck, and it's going to cost them a lot, like 8.8 billion, in order to implement these costs. So they're totally out of control of their costs to make their car because of this union. And every 5 years they got to renegotiate, and you can see their earnings estimates over the next couple of years are flat. They're like -6, -2, 8% maybe in the next year after that. But we don't know, if they're going to have to renegotiate, and it'll charge another 8.8 billion in the next 5 years. I was surprised that Warren Buffett owned GM because they have a very similar profit profile. I'm still wondering why Buffett owns GM, but maybe he'll sell it eventually, and then we'll say, yeah, that was a bad one. But you can see that they're not growing at all here, and the only thing they have to offer is a 5.85% dividend. And I don't know how how reliable that's going to be. But I like to look at their earnings projections, and it doesn't look very good. So this is an example of a stock to avoid for now, until they have some of their costs under control. Abby, there's a new story about Abby. We're following the stock Abby. It's a drug stock, and it used to have the best-selling drug on the market. It's called Humira, and it's I think it was the best-selling drug of all time. It's for arthritis, and they lost exclusivity to that this year, and there's generic competitors. So now their business model is that they lost that, and they're trying to buy companies in order to make up for all those lost earnings. So I looked at their earnings estimates going forward, and from this year to next year, it's going to be negative 0.5%, and then it'll be 9%, 8% after that. So so it looks like it's growing around 8%. It has a dividend of 4.35%, so that's a total return of 12.35%. So I own this just for a diversification, and it seems like it's still growing. And the important thing for this company is that some of these new drugs, if they can't replace this Humira, which they lost in patent expiration, then they're going to have problems. They're buying companies for all this money. They're racking up all kind of debt. So that could be a major problem, especially with high interest rates. So I think the biggest problem with this company is that they have a huge debt problem, and I might reconsider owning this after we see this faltering at all in this annual earnings, and because of the debt payments, that might be a reason to not own this anymore. Okay, here's another story. When I'm reading stories on Yahoo Finance, I like to see, well, does this story affect anything that I'm following or not? And this Pfizer's weight loss drug, it's a potential competitor to Eli Lilly's weight loss drug, which could be, a best-selling drug of all time. And they said their trials have failed. So that's one competitor that could have taken market share, and it's good for Eli Lilly and Novo Nordisk, which are selling competitive weight loss drugs. So let me see. Here's an interesting story from Twitter. We have this guy named Bill Gross. He's named the Bond King. So he knows more about bonds and mortgage and REITs than most people do. And so he's been talking about this, how mortgage REITs, right now we have a situation where interest rates probably are going down. There's like a 70% chance they're going to start going down in April or early next year. And he said mortgage REITs could be a good place to get some high yields. And he thought that they'd go up like 10%. So be careful about tax loss pressure selling, though. So this month, the worst performing stocks are going to be sold for tax loss purposes. That's what I was saying earlier today. So the best performing stocks people are going to be buying, and the worst performing stocks people are going to be selling for tax loss purposes. So he said between now and the end of the year, some of the mortgage REITs that pay really big dividends could still go down more because of tax loss selling, but they'll probably recover next year, and they'll give you a 10% to 15% dividend. So that's interesting that a bond guy that knows this industry would say something like that. I don't really know much about this, but I like to follow smart people. But he's been also saying that these banks are pretty good too, these regional banks. He said there was a bottom November 2nd. That was a while ago. So what I did was I looked at an article that has a little bit of everything here, like REITs and some of these stocks here. So let's look at that. The 9 highest dividend-paying stocks in the S&P 500. And this article is basically saying what are some of the highest yielding stocks. And what I did was I said, well, let's look at some of them to see if they have any validity, see if it's worth even looking at. But I'm thinking right now, with us being at a peak of interest rates, you could see that through the stochastics on, you look at the chart for some of the highest yielding sectors like utilities, you can see utilities are like in a major downtrend because as interest rates go up, no one wants to put their money in utilities to get a 4% return, where you risk the stock going down. Now, what happened here since this month, we're starting to see the utilities break out just a little bit from this downtrend. And what Bill Gross is saying is right now is the time to start looking at some high yielding things, because it's when the interest rates peak and start going down, that's whenever this sector will be, the high yielding things will go back into favor. So the stocks we're following that have high yields are stocks like Philip Morris and AbbVie. These are stocks that haven't done good because as interest rates go up, the demand for high yielding stocks go down. And now that's kind of switching. So we're actually, so what I've been doing very slowly is putting small amounts of money into high yielding things, because I'm like a super high growth investor, and I'm trying to move some of that over time into more high yielding things. So that's more conservative usually. And so I thought it'd be interesting to look at some high dividend paying stocks and see if they have any credence here. Let's look at Kinder Morgan. They own a pipelines where they transport fuel, and so they have. It's very hard to do that. It's very hard to find the land and to dig the pipes and things like that. And they have one of the largest in the country. So so there's a little moat there where it's really hard to actually come up with a business like this. And they're like a toll collector, like Visa. They basically take money for transmitting oil, and it's all based on volume, not necessarily the price of oil. But as the price of oil goes up, there's more oil going through the pipes because there's more being made. But you can see through the earnings estimates that it's growing around 4 to 7%. So let's say 7%. And its dividend is 6.5%. If you add 7 and the dividend, that's around 13% total return. And so this has definitely been out of favor because, if the dividend yield is 6.5%, if you can get 5% or 6% in a zero risk CD or a treasury, no one's going to want to put money into this. But as the interest rates go down in the coming year, this will be more attractive. So this is an example of what I would be interested in, because it's like a kind of diversification into oil. I'm into tech right now, and it's kind of interesting. And if they're growing at 7%, then that's pretty decent for a total return of 13%. Here's one that's a Truist Financial Corp. This is one that Bill Gross mentioned above. Let's look at the ones that he mentioned. TFC, he says regional banks were falling. I mean, he said he hit the bottom, so he thought it was a good time in November 2nd to buy TFC, KEY. So we're going to look at two of those stocks right now, as they are the highest paying, one of the highest yielding stocks. They've been under pressure because they're a regional bank, and there's a lot of regional banks that have that are underwater from some of their treasury purchases, and that's what made some of the banks go down earlier this year. So this stock crashed with all that going on with the banks went out of business. There was a failure of First Republic and Silicon Valley Bank. So it's really hard for us as amateur investors. We can't understand what banks are doing. but I can look at least the annual earnings estimates. There's no visibility. It's only going out to next year, so that's a first problem. The second problem, it's pretty. It's in the bank industry, so we don't know anything about banks, and even the bank analysts. So I don't know. It's not something I'll be interested in, even though I don't think Warren Buffett. It doesn't have a scale. Like for instance, Wells Fargo and J.P. Morgan, they can do things at scale because they're the largest banks in the country. But this doesn't have like any real good thing about them that would set them apart. So here's another company that he did mention, Bill Gross. One is it's yielding, you see, 7%. But you can see it's interesting. Their earnings are scheduled to grow at around 15% year over year. I looked at these. So that's pretty decent. I don't know how they're going to do that as a bank, but so their PEG ratio is 0.66. So they're almost half undervalued. So I'm going to keep an eye on this on our watch list because I thought, wow, that's pretty amazing for a bank to be growing at 15% and being recommended by Bill Gross. So we'll keep this on our watch list just for, I think they call that a bullpen, and they also call it a watch list. Stocks that are pretty interesting, but we're just, it's interesting. Its PEG ratio is 0.66, but there are times, one time a year maybe, that the stock market crashes, and we'll know the history of this stock, and then we'll pick it up half of where it's at right now. But right now it's not compelling enough for us to buy, but we'll watch it. Here's another interesting thing. A lot of times this is that same company, Key Corp, and you can see in the crash of the 2020 where the economy was shut down, that's basically almost where we're at right now. We did it. A lot of times whenever you have a stock that's down, you have a resistance level to where it was before. So this is it was down at $9 a share during the worst of the pandemic. And it went down to like $9 a share like last month maybe. And now it's like at $11 a share, $12 a share. So so there's basically a floor on the stock. I mean, because of its prior support. And so that's really interesting about that stock right there. But still, it's too small of a stock for me to. I'm sure Warren Buffett wouldn't be interested in it because it's pretty small, and it's real easy for a small stock to get caught up in something. And I don't know. I wouldn't put a whole lot of money into a smaller stock. Here's another stock that's yielding a lot recently. It's yielding 6.7%. This is Mark's favorite stock, AT&T. And it actually has a lot of competition. I mean, this is the major reason why it's having problems now. T-Mobile merged with Sprint, and they're actually it shook up a duopoly between AT&T and Verizon. Now there's a competitor that's actually bigger than both of them, and T-Mobile's taking market share. So, but their earnings are pretty steady. I mean, they're not growing at all. You can see that they're growing maybe 2%, 2 or 3%. And I don't know, it's not exciting to me. I like to be invested in growth stocks, but this one would yield probably like a 8% over time, total return. Let me see. Here's one, Verizon. Verizon is similarly, it's not growing much at all. It's growing negative 1%, 2%, 6%. So overall, the dividend yield is 7%. So you'll get like a 9% total return. But you can see it's steady earnings, but they're actually losing market share to T-Mobile over time. So eventually they're going to have to cut their dividend if they don't make money another way. Right now, this isn't really growing that much. So these stocks have a very low PE ratio of 6 because they don't grow. So right now I'm holding this in my portfolio. I'm not excited about it. If this was like negative going forward, it's right now it's at least yielding like 2% over a couple years. So a 9% total return isn't that bad. what I did for each one of these stocks is I listed the years to double. That means for each of these returns, 6.5%. If you divide 72 by 6.5, it'll take 11 years for you to get your money back in that stock if you buy and hold and just collect dividends. And so each one of these has its own, like Philip Morris, Altria. If it's a 9.5% return dividend yield, if you divide 72 by 9.5, that's 7 years, 7.5 years before you get your money back in dividends. So that's an interesting calculation to do, especially when right now I'm starting to dollar cost into some of these because as interest rates are peaking and starting to go down, a lot of times it's good to start looking into those kind of stocks, because eventually, whenever rates are zero again, people are going to be flocking to stocks like this because it's going to be very hard to get a good yield. All right, so let's look at some of the other ones from this group here. Health Peak. This one yields a lot, but one problem with this is, let me see. Okay, so they're like a REIT that operates laboratory facilities. They're actually merging with one of their competitors. So whenever you merge, you have debt involved with that. So right now they have a pretty inconsistent earnings here. It's like negative, but they're like, it's not like a straight line up, and it's not that consistent. You can see negative earnings, negative 20% earnings growth from year over year, from this year to this year. It's not very consistent. I wouldn't be interested in this. And also, you have to deal with potential problems where well, I'm not too sure about this one right here. It's a little small, but it's too inconsistent for me to be interested. If it was 10, 10, 10 or 5, 5, 5, that'd be good. But this inconsistency, I don't think is good enough. Let's look at the Boston Properties. Now, this is another one that's down for a reason. Look at their stock; it's down like a lot this year. The reason is they've had a lot of money in office properties, and as people are starting to work from home, the demands for corporate space is going down. So they're going to have a hard time, getting rid of some of these properties that aren't being used. The corporate office properties. So this is down for a reason. I'm staying away from this sector because I don't know how far that's remote, how much remote working is going to cause pain in this group. And also with interest rates being high, there's a lot of defaults, and I see every day there's companies that are selling office properties way below where they bought it from, where they bought it. So I'm staying away from this, but it has a big yield for a reason. So a lot of times when the stock goes down, the yield goes up, and that's because that's just due to math. But right now this is a sector to avoid, because office properties, we know by looking around us at work, we can see release signs everywhere. So it's going to be hard for this company to continue paying a dividend if they can't rent out some of their properties. Here's one, Altria. I've held this for like really a long time. It sells cigarettes, and they're trying to move beyond smoking into some kind of smokeless tobacco. And but they have 54 consecutive years of dividend increases. So what that means is, for me as an investor, I buy this stock. I know in 7 years, if I buy and hold this stock, and they continue to at least to grow just a little bit, I'm going to get my money back. And on top of that, if their dividend is increased every year, that keeps up with inflation. So if it yields 9.5% this year, then as time goes on, inflation is 2% a year, let's say 2 or 3%. as inflation goes up, this dividend increases, and that helps you with the cost of living and things like that. So, anyways, I bought and held this, and you can see that if you look at the chart of the utility sector, and you look at Philip Morris, this Altria, it's the same chart, because as interest rates go up, the stocks that yield a lot go down. And let's look at Philip Morris, the Altria. There it is right there. You can see it's the same chart. And right now, I'm guessing that Altria is going to start breaking out because it's going to be more attractive as interest rates go down. But for me, it's like a long-term hold. I like that. I like having this high yield in my account. Anyways, Walgreen Boots Alliance. Okay, so they're yielding a lot. They're yielding, but the problem is they've had major problems and their stock is going down. They had disappointing earnings. Their forecasts are going down. They had a good thing with COVID where they had people coming into their places for shots and they bought things. Now they don't have that anymore. And so it's just a very challenging business model where you have to you have a lot of locations and the customers we might be going into recession. So it's retail. It's just something I'm going to try to avoid. Okay, so we had Charlie Munger died this week, and he was the second person in charge of Berkshire Hathaway with Warren Buffett. So I always quoted him a lot over the last many sessions, and what I did was I chose some of his best quotes, and one of the things he said before was you have to find some way to get $100,000 if you're an investor. Whatever you have to do, you have to clip coupons. You have to, not buy something that you need just for scrape, and do what you have to get 100,000, because that's the number where you can actually start making some money and when you're investing. And you see, he said that is the most crucial for building wealth. And he also said, you see, if you're not willing to react with equanimity to a price decline of 50%, 2 or 3 times a century, you're not fit to be a common shareholder, and you don't deserve the mediocre returns you're going to get. What that means is, if you buy stock in a business, you don't want to be buying and selling it every day. It's like if you bought a farm, you wouldn't go to someone and say, how much is that farm worth tomorrow? You're going to say, well, it produces 20 bushels of corn and per year, and that's going to yield this much, and it's going to make this much money for me over time. So you shouldn't be quoting and getting in and out of stocks. You should be willing to go through big declines, and right now there's stocks that are going up, and not sell out of them. And then you'll get better returns. Okay, so his formula for investing is you spend less than you earn. And then you invest shrewdly and avoid toxic people, toxic activities, and you have delayed gratification. And if you do all that, you'll succeed, and you're going to, otherwise you'd have to have a lot of luck to be a good investor. And one thing he taught Warren Buffett started buying businesses that were pennies on the dollar, but weren't good businesses. But when Charlie came around, he said, forget what you know about buying fair businesses at wonderful prices. Buy wonderful businesses at fair prices. So, you see. Okay, the other thing he said was say no to diversification. So Berkshire Hathaway has half of their invested portfolio in Apple right now. And Charlie said that Apple is the best company in the world, and Warren Buffett. And he says whenever you have to try to diversify into different things, like different countries, or it just it defeats the point. If you do your research on the stocks and you follow them, and they're good companies, that you want to try to not diversify as much. He said it's the worstification if you invest in things that are less good than your best top 10 maybe. Okay, so he also liked to read, so he always had a book in his hand, and he's always reading. And Warren Buffett also reads a lot too. So I thought it'd be interesting to go over some fidelity screen. I basically I have this. Let's go over the formula for investing that I have here. Well, it'll be worth it. It'll be worth it. Here, right here. So what I did was I did a screen, return on equity, profit margin, market cap, all these rules that I follow. I do that screen every week. I look at what comes out, and every once in a while we have a new stock to research. And so the simple idea, this is a growth stock, and screen, and it's a buy and hold that most mutual funds follow these, and this is what Warren Buffett basically follows too. And so what I did was I did that screen, and let's look at where it is here. Okay, so we see a lot of stocks we're following at the top of the screen. I sorted by market cap, so you can see we have a lot of the big mega caps here. Google, Meta, United Health is one that's popping up on hedge funds and in our screens. Right now it's a little bit overvalued. MasterCard is here. We have a lot of chip companies that are in this top 10. We have Applied Materials, Texas Instruments, ASML. That's beyond what I understand. I don't understand anything about those, but I like to stick to stocks that have, moats and that are really big. We have T-Mobile in this top list, and okay, so it's good to see the stocks we're following every once in a while when we do our screens. Let's look at some of our news right now. Sectors. Which ones are going up and down? The ones going up the most are the regional banking ETFs. So usually whenever the interest rates go down, let's look at whenever interest rates go down, that's the reason why the regional banks go up. Let's look at the 2-year. 10-year. I bet you the 10-year is down today. Okay, look, it's down a lot actually. So as the interest rates go down, you're going to see all the reason why the regional banks failed earlier this year was the interest rates were going up, and they had a lot of losses in their bond portfolio. But as the interest rates go down, a lot of these stocks that were problems are now recovering. So we have banks, regional banks, and retail, home builders. That makes sense because as interest rates go down, it makes houses more affordable and people buy more houses. So I don't know if I just think this. I didn't follow the Treasury rate as much as I do now, but it's almost an inverse correlation to. We have a lot of inverse correlations and correlations to this U.S. Treasury, and right now we have home builders inverse correlation. We have the regional banks inverse correlation. Let's look at the ones that are going. That is ones going up the least. That's surprising. I would think that would go up a lot because as interest rates go down, the cost to grow your business by borrowing money goes down. Let's see why. Okay, let's look at some of the stocks that are going up and down. Maybe get some idea of what's going on there. Okay, so we see. Okay, we have rents. Huh. Okay, what's going up the most? Paramount Global. So Paramount Global actually had a news story today that they were going to make a deal with Apple. So Apple has 2 billion customers. We were talking about this just last week. 2 billion customers. If they can increase the services that they sell those 2 billion customers, that will grow their earnings a lot. And so if they bought a Netflix, last like I was saying, if they bought a Netflix, they could charge each of the 2 billion customers $20 a month. Just think how that adds up. But what they did was they made a deal today. They're in talks with Paramount to distribute their movies to all the 2 billion customers they have. And so that's why that's up a lot. And all the other stocks in that industry are going up with it. So you have Warner Brothers Discovery, for instance. They're going up in that sector. They're in the same sector. So they think they might be doing a deal with them next too. So, but it's right now it's a unproven business model. This Warner business, well, all the media companies are running the streaming. It's very hard to know how much money they're going to make. So Disney is actually losing money in their streaming right now. So it's a very challenging environment. So let's see what else is going on here. Oh, most of these are Zions Bank. That's a regional bank. What are the banks? Comerica is a bank. KeyCorp, that's the one we were just looking at. They're up. See, the regional banks are up because of the interest rates. Pfizer is down because of that weight loss drug we just talked about. It was a failure, so I'm surprised all the tech stocks are down because they usually go whenever the treasury goes down. That the tech stocks usually go up. I don't know. I'm not sure why. And it could be because these tech stocks actually went up a lot in the month of November, so they're giving some of those gains back. But we are overbought, so maybe just the big tech stocks that ran a lot, maybe they just need a little breather. So let's look at some of the other things here. It's the Dow. Salesforce had a really good earnings report yesterday, so they went up a lot, and they're still going up now. What else is happening here? Okay, I can't get anything from that. Okay, so let's look at some more things here. Okay, I just did another screen on Apple. Apple, I looked at their earnings estimates going forward. They're still growing at like 9%, 10%, and their 4P is 29. So their PEG ratio is 3. That's 3 times overvalued. But you can see the difference between this chart and some of the charts we were looking up earlier. There's consistent year over year. It's pretty consistent, the earnings. You can see the lines, they're in a straight line. Whenever you look at the earnings chart like this, you look quarter over quarter. So you can see 168. You compare this quarter to that quarter. You can see the first quarter is always better than the other quarters because they sell a lot of iPhones in Christmas time. And that's reported in January. So, so you can see they're still growing. And this is why I still hold it. And it has a 1% dividend. So if it's growing at 10%, that's like 11% total return. That's not that bad. Let's look at some of the news stories on Yahoo Finance. Okay, so you can see the CNBC is they like to keep track of rallies. They say, oh, we've got a rally. And this basically sells, advertising on their network. If they can get people like sucked into saying, oh, we're in a rally. And so that's part of that media. Whenever I looked at, let's look at the investor sentiment chart. Okay, so we have the media saying we're in a rally, don't miss out. And media attention. It's right here. We get the media attention. We got people saying it's a Santa rally. It's a good time of the year. Then people just start buying. And now we have momentum. So this usually happens at this time of the year. We have good feelings. We hear the bells when we go to shop. And, everyone's in that mood to buy. And so we're starting to have greed also. So the question is not whether we're going to go up this month. It's how much do you actually take off the table before the end of the year, because it's going to happen next year. So anyways, I thought that was an interesting diversion. Let's look at a couple more things here on the S&P, the Yahoo Finance. So you can see that Paramount was up because of this Apple Paramount in talks to bundle streaming services. So I think Apple is going to try to find a way to sell more services to their 2 billion active users. If they can do that, they can really grow a lot. So I expect more of these deals to happen. Let me see what else is happening in here. Okay, so we have Amazon, Microsoft, and Google kind of battling for an AI platform that everyone's going to be using. So Amazon just invested in a AI company, and Microsoft, of course, has their OpenAI, and Google has their Bard, and so there's a big fight for that, and they all have their their platforms for cloud. So there's a three-way competition for that. I'm not sure who's going to win, but it seems like AI, if you have that in as a product, your stock is going to appreciate a little bit more, just because of the AI hype. Let's see what else is happening here. The best month of 2023. So stocks, but the last time we had a gains like this for a month, we had like 7% gains in most of the indexes. That is really good. That's that seasonality we were talking about at the beginning of the year. But I think that same thing could happen in December too. We just started the month right now. What else is happening here? All right, so we do have this media attention right now that could lead into a fear of missing out rally. So people keep piling in and keep buying regardless of how much it's worth. But trees don't grow the sky. So eventually we're going to get to a point we have to check in with reality at the middle of December. So December 13th, all this happiness is going to go away when the Fed says we're raising rates again. So that's why we have a little caution here before in next week and the week after. So that was interesting. What else is happening here? Okay, we have 5 seconds here. We'll review some of the okay, what to do if there's a crash. This is what Charlie Munger was saying. If you can't be willing to hold your stock through a correction, then you don't deserve the returns of a long-term investor. So let's review this just because Charlie said that. And if you ever have a market crash, and it happens maybe once or twice every 10 years, the worst thing you can do is just to sell out and hope you're not going to lose money, because you're invested in a company. It's not something you want to buy and sell. A lot of times you have to, if you're uninvested at the time of a crash, you have to look at some of the ETFs. A lot of times ETFs sell for a fraction, like maybe 70 or 80% of what they're truly worth. And so you have to make sure that you don't sell ETFs in a crash situation, because you get ripped off in a major way, because a lot of times the bid and ask are way not in your favor. And you see, a lot of times quality stocks and indexes will trade down to a peg ratio of 1. We had we had that with Facebook and a lot of the NVIDIA, a lot of the companies that we follow were down to a PEG ratio. Even Google was at $83 a share. That was a PEG ratio of 1. And that is the magic number that if you see a quality stock, we're following it, and it's in the top 10 holdings of the mutual funds. If you see the PEG ratio of 1, that's a good time to start dollar costing into it if you're not invested at all. And it's usually a floor because a lot of traders and investors know that good stocks usually don't sell off a whole lot past that PEG ratio of 1. And, okay, whenever there are crashes of 20% to 30%, a lot of times that's recovered in the next month or two or next 3 or 4 months. So, so it's not a good idea to sell whenever it goes down a lot. So whenever you do sell in a sell-off, you got to make 3 decisions right. You got to know when to sell, you got to know when to get back in, and then you got to replace the investment with something that's better than what you sold. And there's something called and on top of that, if you have gains in this, you have to pay 20% tax on the gains. So you lose 20% in if you sell in a downturn. So that's a good review. It's good to know that every now and then. And one last review. We already talked about this screen I did. This is my theory. It's not something that's like written in gold or anything. It's something I follow Warren Buffett. I follow people that follow Warren Buffett, and they come across these rules to follow. This return on equity is like one of the most super important things. That's greater than 12. That's great. Profit margin is really important. That's how profitable the company is. And market cap, the bigger the company, the more reliable the company is over time. And they have more resources to handle downturns and have more consistent earnings. Forward PE, we like to have stocks with lower PE ratios, but if it's a high growth stock, it has to be relative to how much they're growing. And growth rate, we like to see over 10, and the PEG ratio, we like to buy it around 1. But if it's a quality company, and it's growing steadily, you have to pay more for that. The other things that I look to see in companies are high free cash flow. We like you see the company that has a competitive edge, a monopoly, or some kind of product that other companies can't provide. And we like to see a dividend, and that adds to a total return. And highly predictable growth earning streams. So highly transparent and predictable. So that means a stock like JP Morgan, we know in 20 years there's going to be a demand for banking services, regardless of how many Bitcoins are published. There's still going to be a demand for this product 20 years from now. That's important. Little or no debt. The companies that went down a lot this year had problems with debt, and they had to service it with high rates of interest rates. But the companies that we're following, the high quality companies, have little or no debt, and so they're not at the mercy of interest rates. And the company has good management. That's kind of the hardest thing. We don't know much about. We have to listen and kind of read articles to understand that. But that was a good exercise. I think I've exceeded my time. Thank you very much for attending, everybody. I hope that it helps a little bit. I hope you have a good weekend.
Thank you, Craig.
You too.